The best of money matters. Wealth Tracker.
Welcome to the Wealth Tracker, where we dive into the uncharted territories of niche investment strategies that promise to redefine wealth. Hello, I'm Hongbin Jeong. It looks like there's a new exclusive opportunity in the tequila cask investment space, where you can see an 8.5% fixed annual return. That's right, Gordon PwC has partnered with Tequila Tromba, one of the world's most renowned tequila brands, crafted by Marco Cedano, the creator of the legendary Don Julio brand. Now, this exclusive investment opportunity allows you to purchase blanco tequila casks at 0 years old, age them for 3 years, and earn a fixed 8.5% annual return. So to find out more about this opportunity, joining me now is Samuel Gordon, who is the CEO of Gordon PwC. Samuel, thank you so much for joining us again.
Thank you so much, Hongbin. Pleasure to be back.
Pleasure to have you on again. Samuel, just for some context here, could you tell us by telling us about, this new tequila cask investment opportunity and why you chose to partner with Tromba Tequila?
Absolutely. First of all, just a bit about Gordon PwC. So, as some of your listeners might know, we're a cask investment company. So we enable investors across the world to build portfolios of premium spirits aging in casks. And one of the sectors within our portfolio, indeed, is the premium tequila sector. So this specific opportunity that we have launched through our partnership with Tromba Tequila, it enables investors, as you've mentioned, Hongbin, to achieve an 8.5% annual fixed return over a 3-year term. And essentially how that is achieved by investors is Tromba commit to buy the casks back from them at a set price at year 3 to be used in their extra-añejo, which is 3-year-old tequila bottlings. Mm-hmm. We selected Tromba. Tromba are one of the leading tequila brands in the world, and they are very much at the forefront of leading the premiumization trends within the tequila category.
I see. Well, Samuel, why tequila and why now? I mean, what makes aged tequila an attractive investment compared to traditional assets like stocks or real estate?
Yeah, why tequila and why now, first of all? So one of the unique aspects of cask investments, Hongbin, is investors are able to profit through the aging process. So specifically with tequila, you as an investor would be buying into what's called blanco tequila, which is unaged tequila. And it's a cask investment, so all of that blanco is able to age in an oak cask. And that is left for a period of up to 3 years. And as tequila ages over time, once it reaches year 3, it's known as what's called an extra-añejo tequila, so a 3-year-old tequila. Now, ultimately, throughout that aging process, aged spirits are typically regarded as higher quality. There is an aspect of scarcity to them. And certainly within the tequila sector, they are what is driving the market's growth. They are the most in demand. So that's ultimately how the price increases over time for the aged tequila products. There is, of course, focusing still on that why now point, really when you look at the supply and demand dynamics within the tequila sector today, it is the fastest growing spirit category in the world. The market demand last year for tequila, the market value was $16.5 billion. It is projected to grow at a compound annual growth rate of about 11% over the next 7 years up until 2032, which would take the market to a total value of $42.5 billion. And really one of the key factors that is driving this growth is that premiumization trend. So consumers are now seeking high quality, so 100% agave tequila, and they're seeking aged tequilas as well, like the 3-year-olds extra-añejo that we've mentioned already. At the same time as you've got all this demand growing, it is inherently scarce, not just because of that aging process, but fundamentally the raw materials, so the blue Weber agave that is used to produce premium tequila, it takes 7 years to grow, 7 to 10 years to grow. So it's a scarce plant that is used to produce tequila. You've got the denomination of origin, so it can only be produced in very, very small specific regions in Mexico. And when you compare the amount of brands that there are in tequila, about 2,800 of them, there are only 75 producers actively producing tequila. Mm-hmm. So really, whilst you've got all this growing demand within the tequila markets, there is an inherent scarcity to it as well.
See.
Now, really, when you're looking at wine now, so if you compare it to other asset classes like wine investment, for example, or whiskey investment, tequila today very much is where wine investment was 30 or 40 years ago, and really where tequila investment was 10 or 15 years ago, for example. So investors today have the opportunity to be those early bird investors, be one of the first investors taking a lead into the asset class and potentially making those higher returns in those early years. Your second question about what makes it an attractive investment compared to more traditional asset classes, one of the first points is always going to be diversification. Mm-hmm. So certainly during times of wider economic downturn, geopolitical tensions, instability in traditional markets, we're talking about a premium good here, specifically focusing on tequila. And even during times of rising interest rates, rising inflation, perhaps when purchasing power for consumers across the world is lower, these types of goods are typically very well insulated, and demand can still continue to surge because the target consumer really does well in any economy. So as an asset class, but it does provide investors with a strong diversification tool as a part of their wider investment portfolio. Of course, the ability for higher returns, again, if we're comparing it to stocks and bonds and property markets, investors over the next sort of 3 to 5 years, taking aside this fixed return product, if we're looking at different products, free market products, they're looking at around 13 to 15% per annum within the tequila markets. And for certain investors, again, you've also got the tax benefits. So like our UK investors, our investors in Hong Kong and Singapore, they are not liable to pay capital gains tax on the profits from the investment because it's classed as a wasting asset, which is any asset that can have a life expectancy of less than 50 years. So there are also tax benefits with the investment opportunity as well.
I see. Well, then how does the 8.5% annual fixed return tequila cask investment work? I mean, can you walk us through the process from purchase to resale?
Yeah. So just to preface this this question here and my answer, the market dynamics of tequila are quite unique. So you've got, as I mentioned previously, you've got 2,800 brands, and that number is growing. So that is brands that bottle tequila and sell at retail. And you've got 75 active distilleries that produce tequila. Now, because of the market's growth, you've now got more and more brands that are seeking aged tequila. And as you can tell by those numbers, Hongbin, most brands don't own their own distilleries and they don't have their own storage facilities. So it's extremely challenging for them, and it's extremely costly for them to actually produce and age their own tequila. So they typically operate in the tequila space, these brands, the majority of these brands, what I would call a buy today, bottle tomorrow business model. So they're buying the casks today and they're essentially bottling the casks to sell at retail as soon as they possibly can. Mm-hmm. And you've got two different types of brands. Okay, you've got brands that perhaps are not so concerned about, let's say, keeping future costs consistent or predictable, trying to keep future costs down. They're happy to take the risk, and when they have a requirement for aged tequila, they will come to companies like us, and they'll have to pay the going rates at that point for the aged tequila. And you've also got brands that perhaps do want to keep future costs predictable. They want to keep future costs low. So they will set up contracts like what we have set up with Tromba Tequila to buy the aged tequila at a certain price in the future. And ultimately, they are expecting the price that they are paying to be lower than what the market or the price should be in 3 years' time, for example. So there are your two different types of brands. You've got brands that just buy when they need to buy tequila, and you've got brands that set up these kind of future contracts to lock in their price for their aged tequila in the future. And that's ultimately how we are able to provide our clients with that 8.5% fixed annual return over that 3-year term, is with the latter there, the brands that want to keep their future costs predictable and try and keep their costs low.
I see.
Really the investment process is very simple. So the investors, they buy with this fixed product, they buy the blanco tequila, which is the unaged tequila. That is in a cask. It's in a government-bonded warehouse at the distillery in Mexico. That's then left to age again for a period of 3 years. You've got the contract in place with Tromba, who have committed to buy the cask back from the investor at a fixed price in 3 years' time. And once it reaches year 3, Tromba then buy it back from the investor, and that's when they see their return on investment.
I see. So what guarantees do investors have that their casks will be, bought back by Tromba after 3 years?
Yeah, so put simply, the contract that is in place with Tromba, that is signed between the investor and Tromba directly. It is important to know that the client has the option. So at year 3, it is the client's option to exercise the buyback option with Tromba. And should the investor exercise that option, it is Tromba's obligation to buy the casks back from the investor. Should the investor not exercise the option at that point, they do lose the option, but they would have the ability to sell the casks elsewhere, or perhaps even bottle the casks themselves. However, we will, and we do expect most investors to exercise that option and achieve that 8.5% annual return over that 3-year term.
I see. Well, aside from the fixed return product, you also offer a free market option. Can you explain how that works and how it differs from the fixed buyback model?
Yeah, again, so there are two different types of brands. So as we've discussed, you've got the brands that set up these kind of contracts that we've got with Tromba now, and you've got other brands that they don't set up the contracts, they just look to buy their aged tequila when they're ready, based on perhaps their market demand, bottle the aged tequila.
I see.
So those two different brands allow us to facilitate the two different types of products. The only real difference between them is the resale process. So with the fixed product, you've got a guaranteed buyer there who's going to buy from you on a fixed day at a fixed price at the end of the term. With the free market products, you have a fixed date when you know you're going to have the extra-añejo tequila, but it will be offered out to all of the brands within the tequila markets, and they will have to pay the going rates on that day, whatever that is. One of the benefits of that free market product is that there is, in today's market, an expected higher ROI for investors. So we, with that product, based on our market data and our clients, should expect over that 3-year term with the free market products, they would be expecting an annual return of between 13 and 15% per annum.
I see. Well, many investors like to balance, risk and reward here. How do you recommend investors split their allocation between the fixed and free market products?
Yeah, so the benefit with the free market products, or the nature of the free market products, is that the investor takes all the risk. However, they also have the potential, or they are able to take advantage of the entire upside. So whatever the market does, the investor does. If the market does 15% per annum, then the investor does 15% per annum. With the fixed products, the downside is limited for the investor to 8.5%. However, the upside is limited to 8.5% as well. So no matter what the market does, whether it drops or whether it increases above the 8.5%, the investor does 8.5%. It really depends how an investor would split their allocation. It really depends on the investor's profile. So, for example, Hongbin, we have lower risk investors who, let's say on a portfolio of 10 casks, they might do an entire portfolio of fixed return casks. Or they might do 2 free market casks and 2 fixed return casks, for example. We have investors with more moderate risk levels. And, for example, in that scenario, they could do 5. In a portfolio of 10, they could do 5 fixed and 5 free market casks, or some kind of ratio that suits their profile. And of course, we have higher risk investors as well. So investors, again, on a portfolio of 10 casks, an investor might well do 10 free market casks, or they might do 8 free market casks and 2 fixed casks, for example. So it just, in terms of that allocation and how it's split, it really just depends on the investor's profile. But we are able to cater to investors really with any profile in terms of their attitude to risk.
I see. Well, thank you so much for your time and your insights today, Samuel.
Absolutely. Thank you so much, Hongbin.
Thank you. That was Samuel Gordon, who is the CEO of Gordon PwC. This has been The Wealth Tracker with me, Hongbin Jeong.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.